Starting April 15, the IRS can charge a late filing penalty of up to 25% of the tax you owe. And if your return is more than 60 days late, the minimum late filing penalty in 2026 can be $525. If you are a senior homeowner with Social Security, pension income, IRA withdrawals, or a recent home sale, this is exactly where small mistakes can turn into very expensive ones. In the next few minutes, I'm going to show you where retirees get trapped, which homeowners are most exposed, and what you need to do before the deadline so you do not lose money you never needed to lose. Let's get into it, starting with the part most people miss. There is one IRS rule hidden inside all of this that decides whether your mistake becomes painful or devastating, and most people do not hear it until after the bill shows up. It comes down to one penalty number, and I'm going to reveal it near the end because once you see it, the smartest move before April 15 becomes obvious. And yes, if you own a home, this rule matters even more because homeowners often have extra forms, extra records, and extra chances to get flagged. Missing the filing deadline is more dangerous than most retirees think. Here's what changed for you in real life. A lot of older Americans now have more than one source of income. They may get Social Security, but they also have a pension, required withdrawals from retirement accounts, part-time work, investment income, or money from selling property. That means many seniors who used to think, I probably don't owe anything, suddenly do owe something. And once you owe, the clock matters. The IRS says April 15 is the deadline for most people to file and pay. If you miss it and you owe tax, the penalties and interest can start building fast. Stop! This is the part that surprises most people. The IRS does not care that you were waiting on one more form, or that you were confused about whether your Social Security was taxable, or that you thought your house sale was too small to matter. If you owe and you do not file on time, the late filing penalty usually starts at 5% of the unpaid tax for each month or part of a month that the return is late. That is not 5% once, that is 5% per month, up to a maximum of 25%. And if you drift past 60 days late, there is also that minimum penalty risk I mentioned in the opening. Now let's make this personal. If you are a homeowner who sold your house, took money from an IRA, and had taxes withheld incorrectly, you may owe more than you expect. If you are widowed, filing a different status than before, or living off a mix of Social Security and retirement income, you may also owe more than you expected. That is how seniors get caught. Not because they were hiding anything, but because their tax picture changed quietly. And this connects directly to the mystery IRS number I mentioned. Keep listening, because that number explains why waiting even a little can be much worse than most people assume. So what does this mean for you? It means if there is any chance you owe federal tax, you should not let April 15 pass without filing or taking formal action. The extension myth, point 2 of 4. An extension gives you more time to file, but not more time to pay. This is the sentence that catches older taxpayers every single year. A lot of retirees hear the word extension and think it means the whole problem is delayed. It is not. The IRS is very clear on this. An extension moves your filing deadline, but it does not move your payment deadline. So if you owe money, you still need to estimate what you owe and pay by April 15 to reduce penalties and interest. Write this down. If you cannot finish your return by the deadline, you still have a way to protect yourself. You can request an automatic extension, including by filing Form 4868 or by making an electronic payment and marking that payment as an extension. That matters because many retirees freeze when they are missing a form or waiting for a corrected statement. They do nothing because they feel unprepared. Doing nothing is the expensive choice. If you are still waiting for an important tax document, like a brokerage statement, or you are still trying to organize paperwork from selling your home, you should not freeze and do nothing. The same is true if you are confused about whether money you took from your IRA increased your tax bill, or whether you qualify for a home improvement tax credit. Many retirees delay because they want everything to be perfect before they act. But the smarter move is to protect yourself first. If your return is not ready, file for an extension before the deadline. That gives you more time to complete the paperwork correctly. At the same time, send the IRS as much money as you reasonably can based on your best estimate. Even a partial payment can reduce extra charges and show that you are making an effort. If you cannot afford to pay the full amount, that does not mean you should ignore the problem. The IRS allows many taxpayers to apply for an online payment plan, which lets you pay the balance over time instead of all at once. This does not cancel the tax you owe, but it can help keep the situation under control and prevent it from becoming much more serious. The worst thing a person can do is remain silent and take no action at all. Another major mistake is believing that getting an extension to file also means you get more time to pay. That is not how it works. An extension only gives you more time to send in the tax return itself. The payment is still expected by the original deadline. This matters even more because the penalty for not filing is usually much larger than the penalty for not paying the full amount right away. That means delaying the return itself can become very expensive very quickly. Many retirees do not realize that these two penalties are different and that misunderstanding can cost them a lot of money. So the main message is simple. If your tax return is still incomplete, do not wait until everything is perfect. File the extension before April 15, then pay whatever amount you can. That one step can help reduce penalties, lower stress, and give you more time to finish the return properly. Home sale reporting. Homeowners get into trouble when they confuse not taxable with not reportable. If you sold your main home, downsized, moved in with family, or relocated closer to medical care, listen carefully. The IRS does allow many people to exclude a large amount of gain on the sale of a main home. In simple terms, gain means profit. If you qualify, you may be able to exclude up to $250,000 of gain if you file single, or up to $500,000 if you file jointly with your spouse. Usually, that requires meeting the ownership and use rules, meaning you owned and lived in the home for at least 2 of the last 5 years. Now here is the trap. Many retirees hear about that exclusion and assume the sale does not need attention on the tax return. But the IRS says if you receive Form 1099-S at closing, you must report the sale even if the gain is excludable. That is a huge detail. It means I didn't owe tax on the sale is not the same as I could ignore the paperwork. If you got that form and left it off the return, you may invite a notice later. Let me make that even clearer. Did you sell a long-time home that rose sharply in value? Did you inherit basis records from years of remodeling, additions, or improvements and never organize them? Basis is simply your starting tax value in the home. It helps determine your profit. If your basis is wrong, your gain can look bigger than it really is. And if the IRS sees proceeds reported from the closing table, but does not see the sale handled correctly on your return, that can create a painful mess. Stop. This is the part homeowners miss all the time. Your records matter. The cost of improvements, major upgrades, and closing paperwork can directly affect whether you owe tax and how much. And yes, this ties back to the rule I'm revealing at the end, because when people are confused by a home sale, they often delay filing. That delay is exactly where the damage grows. So what does this mean for you? It means if you sold your home or received a 1099-S, do not assume the IRS already knows it was exempt. Make sure the sale is handled correctly on your return. Some senior homeowners are losing money 2 ways at once, by paying penalties and by missing credits. While some retirees are afraid of owing, others are forgetting credits that could lower the bill. If you made qualified energy-efficient home improvements, the IRS says there may be a credit available for certain improvements placed in service through the end of 2025. Depending on what you installed, the credit can be worth up to $1,200 in one category and up to $2,000 for certain heat pumps, water heaters, or biomass equipment. In some cases, that means up to $3,200 in tax savings for the year. Why does this matter right now? Because seniors often spend on the house for practical reasons, not luxury reasons. New windows to lower utility bills, insulation, a heat pump, a home energy audit, a replacement system that keeps the house livable. Then tax season comes, and the receipts are in a drawer, the paperwork is incomplete, and the credit never gets claimed. That is real money left behind. But there is another issue. Many retirees think homeowner deductions always help them. Not always. To deduct things like mortgage interest or real estate taxes, you generally have to itemize instead of taking the standard deduction. And many older taxpayers do better with the standard deduction. So if you are guessing, you can make the wrong move in either direction. You might miss a credit that truly helps, or waste time chasing a deduction that does not reduce your tax at all. Here is the good news. Seniors do have support. The IRS-backed Tax Counseling for the Elderly program offers free tax help, especially for people aged 60 and older, with special focus on pension and retirement issues. AARP tax aid sites often operate through that network too. So if your return includes a home sale, energy improvements, retirement income, or confusion about what is taxable, you do not have to solve it alone. And this is where the open loop comes together. The people who lose the most money are often not the people with the biggest tax bills. They are the people who wait because they feel confused. They delay, the larger penalty keeps building, and the missed credits never get claimed. So what does this mean for you? It means gather your home receipts, your 1099 forms, and your sale records now. And if you are unsure, get help before April 15 instead of after. Now let's close the loop. The mystery IRS rule is the 5 to 0.5 rule. The failure to file penalty is usually 5% of the unpaid tax for each month your return is late. The failure to pay penalty is usually 0.5% per month. That means the filing penalty is usually far harsher than the payment penalty, and that is why the smartest move before April 15 is not to hide, not to wait, and not to hope it works itself out. It is to file your return on time, or at minimum file an extension, and then pay as much as you can. This is the part I want you to screenshot or write down, because this affects your check directly. If money is tight, protecting yourself from the bigger penalty can save you far more than most retirees realize. Before you go, I have one question for you. Have you ever assumed that an IRS extension also gave you more time to pay? Tell me yes or no in the comments. I read every single one, because the next video I'm releasing covers the biggest tax mistakes retirees make with Social Security, IRA withdrawals, and home sale paperwork. And if you're not subscribed, you will miss it. Hit subscribe now so YouTube notifies you the moment it goes live. Also, go back to 2:30 in this video. There is one detail I mentioned that most people miss on first watch. Now that you know the full picture, it will hit differently.